Alright, let's talk about fear. Not the existential dread of a Monday morning, but the market's fear, the VIX. When the VIX, our market's fear gauge, swings wildly, it signals potential regime shifts and makes hedging a nightmare. Today, we're exploring a fascinating paper that tackles this exact problem, not with a black box, but with a white box AI that acts like a financial Zen master, knowing precisely when to trade, and crucially, when to simply not. The core challenge? Jointly hedging the S&P 500, or SPX, and its implied volatility index, the VIX. Think of it like trying to keep two highly energetic, interconnected puppies on leashes. They pull in different directions, but also influence each other. You want to keep them safe, meaning your portfolio is protected, without constantly yanking their leashes, which in finance means incurring hefty transaction costs. This isn't just about managing risk, it's about doing so efficiently and transparently. Now, when we say white box AI, we're talking about transparency. Unlike a black box model, where decisions are made by an opaque neural network, a white box approach means every decision, every parameter, every constraint is understandable and auditable. In finance, this isn't just a nice to have, it's critical. You need to know why your system made a trade, especially when millions, or billions, are on the line and regulators are watching. This white box system has two main components. First, the market teacher. This isn't some guru predicting the future, but a sophisticated model that learns from current option prices to construct an arbitrage-free view of the market. It uses techniques like SSVI to build a smooth surface of implied volatilities, essentially mapping out the market's collective expectation of future price swings across all strikes and expiries. It also incorporates a CBOE-compliant VIX calculation, ensuring it understands the fear index exactly as the market does. From this implied volatility surface, the teacher then extracts the local volatility using a clipped, convexity-preserving Dupire local volatility extractor. In simple terms, if implied volatility tells you the market's average expected wiggle, local volatility tells you the expected wiggle at a specific price and time. It's derived from the partial derivatives of the option price with respect to strike and expiry, linking static option prices to the dynamic evolution of the underlying asset. This is crucial for understanding how the market moves moment to moment. Second, we have the control layer. This is our Zen master. It doesn't just react, it proactively enforces safety. It frames hedging as a small quadratic program, an optimization problem where it tries to minimize risk while adhering to strict safety constraints. These constraints are like invisible force fields, called control barrier functions, that keep inventory levels, trade rates, and crucially, tail risk within predefined safe boxes. It's about disciplined, constrained action, not reckless pursuit of profit. At each step, the control layer solves a quadratic program, or QP. It's essentially minimizing a cost function, often related to portfolio variance or hedging error, subject to linear inequalities that represent our safety constraints. Think of it as finding the optimal trade size, delta, or gamma, that keeps your portfolio within the safe zone defined by your control barrier functions, while also considering transaction costs. The paper proves the existence and uniqueness of solutions to this QP, ensuring the system always has a clear, optimal path forward. But what truly makes this a Zen master is its sufficient descent execution gate and tail safety upgrades. The gate ensures it only trades when the expected risk reduction justifies the transaction cost. No nuisance turnover. And for those extreme, low probability tail events, it has special rules: correlation-aware VIX weights, guarded no-trade bands, and expiry-aware micro-trade thresholds with cooldowns. This prevents overreacting to market noise and ensures stability, even when the VIX is particularly volatile, as we sometimes see in today's markets. The results are compelling. In reproducible synthetic environments, this controller significantly reduces expected shortfall, meaning less severe losses during adverse events. It also suppresses nuisance turnover, saving on transaction costs. And the market teacher's surface construction keeps index-level residuals small and stable, meaning its understanding of the market remains accurate. It's a testament to how rigorous mathematics, combined with a transparent, safety-first AI, can truly revolutionize risk management. So, what does this all mean? It means moving beyond black box predictions to white box understanding. It means building financial systems that are not just smart, but provably safe and transparent. This isn't just about making more money, it's about building more resilient, robust financial markets. It's where the elegance of mathematical control theory meets the unpredictable, often chaotic, reality of market dynamics, creating a future where our financial systems are truly tail-safe.